The stock market can feel like a high-stakes guessing game, right? But what if you had a simple toolkit to turn all that guesswork into genuine confidence? Well, today, we're going to build that exact toolkit. We're cutting through the noise, through all the jargon, to find the core ideas that drive smart investment decisions. Let's get into it. So, are you investing? Or are you just guessing? That feeling is what keeps so many people on the sidelines. But look, it doesn't have to be a total roll of the dice. By the end of this, I promise you'll have a clear framework that'll shift you from just guessing to making truly informed choices.
All right, first things first, let's start with the big question. When you put your money into a company, how do you actually get paid back? Let's look at the two main ways a successful company shares that success directly with you as one of its owners.
All right, let's break this down. On one hand, you have dividends. Think of a dividend as the most direct thank you a company can give you. It's literally a slice of their profits, handed out as either cash in your pocket or more stock. Then you've got something called a bonus issue. This is kind of like a loyalty reward. The company just gives you extra shares for free, just for being an investor. So that 1-for-5 bonus means for every 5 shares you own, they just give you another one. It's basically the company reinvesting in you.
Okay, so why should you even care about dividends? What's the big deal? Well, for one, they can give you a steady stream of income, which is always nice. But, and this is the big one, it's a huge signal from the company's management. They're pretty much shouting, hey, we're making money, we're doing well, and we're so confident about the future that we can afford to share the wealth. That kind of confidence can also make your investment feel a whole lot safer, especially when the market gets a little crazy.
Okay, so knowing how you'll get paid is great, but that's really only half the story, right? I mean, you wouldn't buy a car without popping the hood, and it's the exact same idea with a company. This next tool is all about checking its financial health. It's a technique called fundamental analysis, which is really just a fancy way of saying we're going to give the business a full checkup.
And what's the number one tool for this checkup? It's the earnings report. Seriously, you can just think of this as the company's official report card. Pretty much everything you need to know about how that company is really doing, it's all in there.
All right, so you've got this report card in front of you. Where do you even start? Well, it tells a story in 4 key parts. First, you look at revenue. That's all the money that came in the door. Simple enough. Then, you subtract all the costs and taxes to find the profit. That's the bottom line, what's actually left over. Next, the balance sheet gives you a snapshot in time, what the company owns balanced against everything it owes. And finally, you have cash flow. This one's crucial because it shows you how cold, hard cash is actually moving through the business day to day. Okay, so we know where to look, but in that sea of numbers, what are we really looking for? Let's boil all that data down to just 3 essential numbers. Think of these like the most important gauges on your investor dashboard. First up, we have EPS. That stands for earnings per share. And it's super simple, but really, really powerful. It just tells you how much profit a company made for every single share out there. You just take their total profit and divide it by the number of shares. A nice high EPS is a fantastic sign of a profitable business. But hold on a second. A high EPS, is that enough? Is that the whole story? If a company is earning a lot, does that make it an automatic buy? Well, not quite. Because a great EPS doesn't tell you a thing about the price you have to pay for it.
And that's where our second number comes in, the P/E ratio, or price to earnings. This little number gives you all that missing context. It takes the stock price and compares it directly to the earnings. So, a really high PE could be a red flag that the stock is way too expensive, maybe overhyped. On the flip side, a low PE could mean you stumbled upon a real bargain. It helps you answer that all-important question, am I getting a good deal here?
All right, our third and final key number is book value. The easiest way to think about this is, what's the company's fire sale value? If they had to sell off everything tomorrow, all the buildings, the inventory, everything, and then use that cash to pay off every single one of their debts, what would be left over for the shareholders? That's the book value. It helps you see if you're buying into real, tangible stuff or just paying for market excitement.
So, there you have it. That's it. Those are the core pieces of your brand new investor's toolkit. We've talked about how companies can pay you, and we've learned how to check their vital signs. Let's put it all together.
So let's do a super quick recap of the whole toolkit. Tool number 1, shareholder rewards, tells us how a company pays you back, using things like dividends and bonus issues. And tool number 2, fundamental analysis, is how you check the company's health, using those 3 key numbers, EPS, the PE ratio, and book value. That's your foundation.
Look, if there is just one thing you take away from all this, I hope it's this. Smarter investment decisions are built on understanding, not on speculation. It's not about chasing hot tips or trying to guess the next big thing. It's about really understanding the business you're putting your hard-earned money into.
So now you've got the tools. You know what to look for, you know the right questions to ask. The only question left is, what company are you going to analyze first?